Hello everyone and welcome back to Explain the Charts, your go-to channel for no-nonsense technical analysis. Today is November 20th, 2025, and we are looking at a sea of red in the Bitcoin market. The headlines are painting a grim picture, with major news outlets reporting a Bitcoin price crash to the $88,000 range, hitting a 7-month low. Reports are citing a storm of bearish factors, including massive liquidations, significant ETF outflows, and a general risk-off sentiment spreading across markets. Market fear is palpable, and many are wondering just how much lower Bitcoin can go. In this video, we'll first analyze this news and then dive deep into the BTCUSD charts to see what they're telling us and where the price could be headed next. Let's start by pulling up the daily chart to get the big picture of this recent, dramatic price action. Looking at this daily chart, we can see the broader story of the last year and a half. Bitcoin had an incredible run-up starting from mid-2024, climbing from the $50,000 all the way to a peak above $123,000 in July 2025. That high, around $123,231, now stands as a monumental long-term resistance level. Since that peak, the price has been in a clear corrective phase, making a series of lower highs and lower lows. A significant area of volatility to note was back on August 5, 2024, where we saw a massive drop. Let's zoom in on that period for a moment. Here, between late July and early August 2024, you can see the price trying to break out before this colossal red candle on August 5th. The price dropped from an open of over $58,000 to a low near $49,000 in a single day, which shows just how quickly sentiment can shift in this market. This was a major shakeout before the next leg up, and it's a good reminder of the volatility inherent in Bitcoin. Now, let's return to the full view and focus on the current situation. Returning to the present day, the price has now decisively broken down from its recent consolidation range. The news reports a 7-month low, and we can see that confirmed right here on the chart. The recent low from yesterday, November 19th, was $88,483. This level lines up with a support zone established back in February and March of this year, making it a critical area. The previous attempt to break all-time highs failed in mid-July, and another lower high was made in early October around $126,000, confirming the bearish structure. The key support we were watching around $93,000 has been shattered, and it will now likely act as strong resistance on any bounce attempt. The volume on this recent drop has been significant, indicating strong selling pressure, which aligns perfectly with the news of liquidations and ETF outflows. We have now had 3 consecutive large red daily candles, showing intense bearish momentum. To understand this breakdown better, let's switch to the 1-hour chart. On the 1-hour chart, we can see the blow-by-blow of this recent crash. The price was struggling to hold above $93,000 before a sharp cascade of selling took us straight down. Notice the long wick on the candle that made the low at $88,483. This indicates that buyers did step in at that level, causing a bounce. However, the subsequent price action has been weak. We are seeing a slight recovery, but it's struggling to gain any meaningful traction above the $91,500 level. This pattern could be the beginning of a bearish consolidation, often called a bear flag, which typically resolves to the downside. The immediate resistance is the breakdown level around $93,000, and a secondary resistance sits near $91,800 where the price has recently been rejected. For a closer look at the current struggle, let's zoom into the 15-minute chart for the most recent trading hours. Here on the 15-minute chart, we can see the intraday battle playing out. After the sharp drop to the $88,000, the price managed to bounce back. However, observe the price action over the last several hours of November 19th. The bounces are becoming shallower, and the price is compressing into a tight range between roughly $91,400 and $91,800. This suggests indecision in the market. Bulls are trying to defend the bounce, while bears are looking to reload their short positions at higher prices. A break below the immediate support around $91,200 could signal that the bounce is over and we are heading for a retest of the lows. Conversely, a strong push above $92,000 could give bulls some short-term hope for a larger relief rally towards that $93,000 resistance. So, what's the overall outlook now? Let's formulate our bullish and bearish cases. Let's go back to the daily chart for the final summary. The bearish case is currently the stronger of the two, supported by both the news and the technicals. The trend is clearly down, key support has been broken, and market sentiment is extremely fearful. If the current bounce fails, the next logical targets for bears are the prior lows. This includes the support level around $85,000 from late February and the major support zone between $77,000 and $80,000 from March and April. A daily close below the recent low of $88,483 would reinforce this bearish outlook. On the other hand, there is a case for the bulls, though it is a more difficult one to make right now. The bullish argument hinges on the idea that this sharp drop was a final capitulation event, shaking out weak hands before a reversal. The price has bounced from a 7-month support level, which is significant. For bulls to regain control, they need to push the price back above the broken $93,000 support and hold it. If they can achieve that, it would signal a potential fake breakdown and a move towards $95,000, and even the psychological $100,000 level could be back on the table. This would require a significant shift in sentiment and a surge in buying volume. Let's recap the key levels and potential scenarios. Immediate resistance is at $91,800, followed by the major hurdle at $93,000. Above that, we have resistance at $95,000. For support, the recent low around $88,500 is the first line of defense. Below that, we look to the support zones at $85,000 and the critical area around $80,000. Here are my unbiased predictions. There is a 60% probability that we see further downside or consolidation before another leg down. The bearish momentum and negative sentiment are very strong, suggesting this correction isn't over. I'd expect a retest of the $88,500 low, and if that breaks, a move towards $85,000 is highly likely. There's about a 30% chance the price gets stuck in a choppy range between $88,500 and $93,000 for the next several days as the market finds its footing. Finally, there's a low, 10% probability of a powerful V-shaped recovery that reclaims $93,000 in the short term. This would be an unexpected outcome given the current market conditions. Keep an eye on trading volume. A high-volume bounce would lend credibility to the bulls, while a low-volume drift upwards would favor the bears. That's our analysis for today. Thank you for watching this episode of Explain the Charts. Please remember, this content is for informational purposes only and is not financial advice. The cryptocurrency market is extremely volatile, and you should always do your own research before making any investment decisions. Trade safe, and we'll see you in the next video.